Hello, my name is Maria Bezupova and you're at my channel Fertilizers Jazz. Here we talk about events, trends, technologies in the world of fertilizers and agriculture. Please subscribe to the channel, put like to this video, and let's jazz! Today is April 7 and this is a weekly markets update. Let's have a look at the news of week 14 and see what are the next trends. Please check out my interviews with Chris Lichopoulos and Silvia Traganida, senior market editors from ICIS, who uncovered in our regular quarterly interviews the situation in phosphates and ammonia markets, and shared their view regarding Q2 prospects. So don't miss the jazz. Wow, what a week it was! US tariffs news bomb exploded in the middle of the week, causing a tsunami literally everywhere in all countries and markets. So, of course, today I will focus on the effect of these measures on fertilizers. But before we start further analysis, I would like to point out to several major uncertainties that we need to take into account. First, and perhaps most uncertain of all uncertainties, is the actual introduction of tariffs for individual countries, as per the list announced. What I mean, during first 2.5 months of Trump's presidency, it became clear that nothing is carved in stone and everything can change in a blink. It can change if the better deal is proposed to the US. The next day after tariffs announcement, the news emerged that certain countries are already discussing such deals with the administration in order US cancel or significantly decreases the tariffs for these countries. India, Vietnam and Israel are in talks, but perhaps not the only ones and definitely not the last ones. Of course, this is the major problem for anyone doing forward planning. What we can do about it? Not much. The only thing we can run many different scenarios. But unfortunately, the final outcome of tariffs regulation might be not based on our common business logic. Second major uncertainty is related to the tariff size for Russia. For now, there is no clarification from the US authorities. The market is waiting, hopefully soon. So it is unclear if Russia belongs to the group of countries which is actually the whole world with basic tariff of 10%, or if the comment of Trump's administration is correct, that Russia, Belarus, North Korea and Cuba are not subject to any tariffs because countries are already under sanctions and US doesn't trade with them. We know this is not true, but seems like administration has its own subjective view and different objective matters. So, in the latter case, Russia will export to US with zero tariff. I'm wondering if this exemption is that help for their international fertilizers trade that was demanded by Russians, among other points, as a condition for ceasefire in the war that they started against Ukraine. I don't know. We will see how it plays out finally. But in our further analysis, let's assume that the tariff is zero. And third uncertainty is related to the tariff size for Canada and Mexico. There were no additional tariffs announced for these countries because the previously announced 25% is in place. But those goods that are covered by US-Mexico-Canada Free Trade Agreement will continue to be imported without duties. Now the question is how this free trade agreement will be applied specifically to different fertilizers. The principle is that all products produced from 100% domestic raw material are covered by the agreement. So, seems like ammonia, urea, other nitrogen fertilizers that are produced from Canadian gas should not be the subject to duty. Same for potash, obviously, which is in any case an exemption. Sulfur as well. But how the norm will be applied to Mexican phosphates, which are produced partially from imported phosphate rock and ammonia, is not clear. But in our analysis, let's assume that the tariff is zero as well. Let's start with the urea, and I would like to thank ICIS for providing this data. Urea imports are split between many countries, but the elephant in the room is obviously Russia, which reached 25% share of imports last year. If the tariff is zero, then clearly Russia will have a carte blanche for increasing its sales, and only granular product production volume will be the limit. Middle East urea will be subject to 10% duty, and it will affect almost 40% of US imports. Two regular supply origins from Africa, totaling 16% of imports, were hit the most. These are Algeria with 30% duty and Nigeria with 14%. Both levels are in fact prohibitory for imports. At the same time, Egypt product will be subject to only 10%, same as Middle East. So Egypt might potentially replace Algerian and Nigerian tons. Also, Black Sea product will pay 10%, which gives more opportunities to suppliers from this region to compete in the US. Next question is, what will happen with all those tons that will be pushed out from the US market? Middle East producers might decide to focus on other markets nearby, for example, Australia and Southeast Asian markets, and give at least part of their market share in the US to other players. Algeria will need to increase its share in Europe, but this incremental volume is limited. The main volume Algeria will need to place in Brazil and Central America. Same with Nigeria, but of course Algeria will have an upper hand in Europe because of zero duty. Other suppliers will easily place their US export tons elsewhere because mostly these were opportunistic sales and small amounts. And finally, we shouldn't forget about USA urea exports, which makes around 1 million tons annually. About half of it usually goes to Canada, and the rest to Mexico and other countries of Central and South America. So, depending on the retaliatory measures from different countries, especially from Canada and Mexico, US potentially can divert this volume to the domestic market. Let's move to other nitrogen products. Ammonium nitrate imports to US is a significant volume, more than 2 million tons annually, but much more concentrated in terms of suppliers. Russia dominates with almost 50% share. So again, if the tariff is zero, then perhaps Russia will shift focus from Central and South America to the US market. And if tariff is 10%, then it will be the same for Russia and Trinidad and Tobago, which is the second largest supplier, meaning that the playing field will not change much. Suppliers that are affected with higher tariff rates are not playing a significant role and will be substituted by majors. And same as in urea, more than 80% of US nitrate exports goes to Canada and Mexico. So this flow might be diverted to the domestic market, at least partially. Ammonium sulfate supply will be affected the most because almost half of it was arriving from the EU, and it will be subject to 20% duty. It is difficult to substitute these amounts because there are no other major producers of granular sulfate globally, apart from China, of course, which is out of question. So, in this case, we might see decrease in sulfate consumption in the US, substitution with other products perhaps. And finally, let's have a look at situation in phosphates, specifically DAP. US DAP imports are very concentrated. 90% is coming from 4 countries. Saudi Arabia recently took the place of Moroccan and Russian product after US imposed countervailing duties at product from these countries. Now, with 10% duties, Saudi Arabian producers still will be in the best position. Also, Moroccan market share was taken by other non-traditional suppliers like Egypt, Jordan, and Tunisia that were increasing their share year on year. Egypt, with the same tariff of 10% as Saudi Arabia, will sustain its share perhaps. However, Jordan was hit by 20% tariff, which is a prohibitory level. So, about 300,000 tons of Jordanian product will need to find new home, which might be Europe, and also markets of Southeast Asia. Tunisia is another new supplier to the US market, which will leave it because 28% tariff is not workable. And diverting US exports might bring maximum 500,000 tons. So let's wait until the dust will settle. Too many moving parts that came into motion simultaneously, and too many unknowns that prevent from quality forecast. Some of these unknowns will be clarified soon, I think, so we will follow them together. On the background of tariff news, the Indian urea purchase tender was almost forgotten, but obviously it is still one of the most important factors of urea market. The tender will close tomorrow, so we will start hearing first news in a couple of days. US tariffs changed the whole landscape, and Indians perhaps were not expecting that. The US market responded to tariffs news with spike in prices. Some tons were sold at Nola at $420 to $30 per short ton. At the end of the week, prices retreated to the level around $400. Also, at the beginning of last week, news emerged that there are again some hiccups with gas supply in Egypt, which resulted in production cuts. Thus, despite the Eid holidays, Egyptian producers stepped in the market and conducted round of sales, which increased FOB price from $365 to as high as $395. Sales from Algeria done at 400 FOB supported this trend. So, if a week ago, when the market was in a really gloomy mood, the valuations of L1 in the Indian tender were somewhere around $375 CFR, now after a price rally, market expects L1 to be at least $10 to $15 higher. So at the end of the day, looks like India will not achieve its goal to decrease purchase price by prolonging tender announcement this time. Paper values surged across the globe, of course. Egypt FOB future price jumped by more than $30 for April and May, and June price corrected upwards by $23. Nola reaction was less extreme. Correction for April and May was less than $10, but for June price increased by $13. However, more upward correction is expected. Arab Gulf FOB future price increased by $15 to $17 for all 3 months. Brazil jumped by more than $20 for April and May and by $15 for June. What a roller coaster! In fourth phase, with religious festivities underway, the focus for the market has been more on government policy rather than business deals. In India, the government announced not just the DAP special package will be extended until at least September, they also finally announced nutrient-based subsidy rates for Kharif 2025. No big surprises there. The level is around 6,000 rupees that we discussed a week ago. But the subsidy announcement, along with Q2 phosphoric acid settlement the week before, provide a lot of clarity for buyers. The new subsidy rate brings the break-even import price for DAP at $600, which is far away from recent deals at $640. Indian DAP producers who use imported ammonia and phosphoric acid will face the loss of around $25 per ton. All those losses to producers and importers will need to be compensated by the government. Now, India will await news out of China for resumption of phosphates exports and news of talks with OCP for the DAP TSP deal. Ethiopian EABC has awarded 60,000 tons lot at $647 FOB Saudi Arabia to Mid-Gulf and issued counterbids for the same price for other 7 lots. Traders will need to respond to the counterbids until tomorrow. Moving to the fundamentals. Tariff shockwaves swept through all commodity markets. European natural gas futures dropped over 8% to 36.5 euros per megawatt hour, nearing their lowest levels since September 24, driven by fears that the ongoing global trade war could reduce industrial activity and lower gas demand. Global recession could lead energy-intensive industries to scale back operations, reducing future energy needs. Additionally, the rise in oil output from May and potential changes to European storage targets may increase gas supply. The market also anticipates more LNG shipments to Europe due to lower demand in China, with weak Asian LNG consumption in 2025, potentially keeping European gas prices lower. US natural gas futures also dropped below $3.9 per MMBtu due to the same reasons. Meanwhile, investors are closely watching supply and demand trends. The latest Energy Information Administration report showed US gas storage levels remain 4% below normal, despite 3 consecutive weeks of injections. LNG exports hit a record of almost 16 billion cubic feet in March, while gas output also peaked, but has started declining in April. Weather forecasts suggest temperatures will stay near normal through mid-April. Agricultural commodities future prices for wheat and corn were in red, while soybeans dipped more. Wheat futures dropped to the levels similar to last week following the growth demonstrated until April 1 after China announced a retaliatory tariff on US goods. On the supply side, the USDA's March prospective plantings report projected a 2% decline in US wheat acreage this year. If realized, this would mark the second lowest all-wheat planted area since more than a century. Corn futures also dropped after tariffs announcements, but then rebounded on Friday to $4.6 per bushel. The market stayed supported by the prospects of a tightening US and global corn supply picture. Currently, US export demand and ethanol usage is running ahead of USDA targets for the marketing year. Market analysts are looking to this week's USDA WSDE report for an increase in corn demand. Also, traders are closely monitoring a powerful spring storm moving through the US Corn Belt. Heavy rainfall is forecast for key growing regions in the southern Corn Belt, where saturated soils could raise concerns about potential planting delays. However, reckoned corn planting acreage valuation of more than 95 million acres, announced at the beginning of last week, will weigh on market prices further in the year. Soybean futures dipped below $9.8 per bushel, their lowest level since late December, as Chinese, world's largest soybean importer, announced a retaliatory tariff on US goods. On top of that, yesterday, OPEC announced they would increase output by more than 400,000 barrels per day next month, equivalent to 3 monthly increments. They cited healthy fundamentals and a positive market outlook. These caused crude oil futures to drop by over $5 per barrel again today, which in turn led to a decline in soybean oil prices as well. So everything is much more interconnected than many governors would imagine, I think. Moving to the shipping industry. Containerized freight index increased by 100 points during the week. Rates for container shipment from China to US surged by 10%, while other directions continued decreasing. The Trans-Pacific trade lane witnessed a reversal of its months-long week-on-week trend of declining spot rates due to the recent sailing cancellations. The imposition of tariffs is anticipated to introduce greater volatility to these spot rates. The Baltic Exchange Dry Index dropped by 7% week-on-week. The Capesize market started the week slower and ended with even more bearish sentiment, partially due to holidays in Hong Kong and China, so limited activity of miners. For Panamax segment, the week was also slow, with lack of demand in both basins and fears mounting regarding tariffs effect. In Ultra Supramax segment, the situation was similar. Handysize segment was the only one where sentiment at least remained flat. To sum up, USA tariffs shock all commodities markets, and reaction will be visible both in short and long term. In fertilizers, in the short term, the main challenge has arisen for US urea importers to secure immediate tons that they are needed to cover increased consumption. Thus, FOB Nola prices surged last week. Indian government also found itself in the eye of the storm, with urea purchase tender closing on Tuesday. The tariffs news immediately elevated expected L1 price by $10 to $15 minimum. The long-term consequences will depend on how the main uncertainties will be resolved, specifically final tariff size after negotiations with White House administration, tariff size for Russia, US-Mexico-Canada agreement interpretation regarding tariffs for fertilizers from Canada and Mexico. But in any case, global fertilizers trade flows will change, and the market will need to quickly adapt. That will be an eventful time. Gas price both in Europe and US dropped last week as there is concern persisting about potential business activity depression, and also due to milder weather. Agricultural commodities future prices showed nervous fluctuations, and the main drop was registered in soybeans, which might influence the most significant change of trade flows. Container shipping costs surged last week, while activity in bulk shipping was subdued across segments and geographies. So let's see what is next around the corner. But it will be already next week. Thank you for watching. Please subscribe to the channel, put like to this video, push the bell in order not to miss any updates, and see you soon.